So in practice, when companies borrow in the debt market, they have to make this choice of whether they want a fixed or floating rate interest rate. And oftentimes these floating interest rates can be lower cost, but then it's of course uncertain because you don't know where they're going to go. If interest rates in the economy go up, then so does the cost of this loan. Whereas if you get a fixed interest rate loan, that's by definition, it's fixed. No matter what happens between now and the end of this loan, your interest rate is going to be the same no matter what. So it's nice because you get the certainty when you have a fixed rate loan. But often it tends to come at a somewhat higher cost than its variable counterpart. So let's look at three scenarios in turn for a company. Let's say we work at a company and we're looking at borrowing $10 million for the next 2 years, and we want to compare three different loans. So option number one here is that we could this is probably the simplest option. We borrow $10 million for 2 years, and it's a 3% fixed interest rate. Now, the benefit of this is that basically we're assured. Access to capital is assured. We know exactly when we need to pay it back. And between now and the next 2 years, we don't need to worry about finding additional financing. But in addition to that, the certainty over the cost of capital is also fixed. It's certain. We know exactly what the cost of capital is going to be every year with a 3% fixed interest rate. Every year for the next 2 years, we pay $10 million times 0.03. That's going to be our payment. And that doesn't change no matter what for this loan. So these are two benefits of option one. And you can clearly see the major theme here is certainty. The other option is to pick a loan in which we borrow $10 million at a variable interest rate. We pay LIBOR or some other benchmark that might be popular at the time, plus 1.5%. And then this is going to be our credit risk premium. So we don't get to borrow at LIBOR because LIBOR is like a bank rate. It's the rate at which one bank charges to another bank for an overnight loan. We, as a corporation, are probably more riskier than a bank or the average bank. And so we pay a credit risk premium on top of LIBOR. And in this case, maybe we're not that risky. So it's kind of a small amount of credit risk that we have. We're unlikely to default. And so our credit risk premium might just be, say, 1.5% per year. But whatever it is, we pay the credit risk premium plus whatever LIBOR is. And LIBOR, our payment, we make one payment now. We make one payment in 6 months. We make another payment another 6 months later. Whatever LIBOR is at that time, at that 6 month cutoff time, that's the interest rate that is due on our loan. So it's still a 2-year loan. It's just that the interest rate itself that we pay resets every 6 months. So, for example, if we were going to look at let's say we pay every 6 months, and we were going to look at what the first 6 month payment would be, then if LIBOR is at, say, 1% right now, we'd pay LIBOR plus the credit risk premium of 1.5%. And since these are annualized numbers, and we're making payments every 6 months, we can just divide by 2. And then that's going to be the effective interest payment in 6 months. And every 6 months, as we make a new payment, this changes. The credit risk premium, that still stays the same. And the only thing that changes is this number here. This can go up, can go down, depending on whatever LIBOR is doing at that time. So like our first loan here, option number 1, we still have certainty over access to capital. That is, we know that we're still going to have a loan in the next 6 months or the next year. It's still a 2-year loan. It's just that we're uncertain about what we're actually going to pay from one 6-month period to the next. The interest rate varies. So what we're not certain about is essentially the cost of capital for this loan, how much it's going to cost us. And then the final option that we can look at is we can actually just borrow $10 million for 1 year. And we can get a fixed or variable rate loan. Let's say we just borrow $10 million fixed at 2.5%. And then we still need 2 years of financing. It's just at the end of 1 year, we pay back the 10 million, and then we go find a new loan for 10 million for 1 additional year. So for here, certainty over access to capital, though, is actually uncertain. It's certain for the first year, but the trouble is with this approach is after 1 year, we have to pay it back, and then we have to go and shop around for a loan again. And it's not guaranteed that we can actually find a loan or a loan at favorable terms at that time. It could be we find a better loan if we've become a better company, but if our financial conditions are expected to deteriorate, we may actually prefer to lock in a 2-year loan right away using one of these 2 options rather than kind of risk going to the banking market and getting a new loan when our conditions not as favorable and we face a higher credit risk premium. And moreover, our cost of capital is uncertain. We know what the cost of capital is going to be for the first year, but we don't know what the interest rate is going to be when we go and get a new loan 1 year after that. So these 3 different options, they just show trade-offs, and which trade-off should you select really depends on the condition of your company and what your expectation is about interest rates going forward. If you think interest rates are going to rise, for example, you might be inclined to choose a fixed rate loan, and you might be inclined to lock it in as long as possible. But if you think interest rates are going to fall, then perhaps you wouldn't want that. You would want to stick with something with like say LIBOR, because if interest rates fall, so does LIBOR. Or you just get a short-term loan with the expectation of refinancing 1 year later at a lower interest rate because market rates have dropped.